Hello, everyone. 2021 was the year of few positive surprises. As the vaccination rate went up, so did the market's confidence to return to normality with few bumps along the way. Like spread of the new variants and navigation through regional, national, and international lockdowns. The European securitization market overall had a positive year in terms of both issuance and performance, and in some areas surpassed its previous expectations. But pandemic is far from over, and there are other factors emerging, and this is the topic of our presentation today. We will be discussing our expectations around performance and issuance of the European structured finance in 2022. So welcome to our latest webinar. Every month, we pick one topic concerning a European structured finance and update our listeners on the DBRS Morningstar credit views. My name is Vidasa Chaudhary, and I head up the European structured finance research efforts at DBRS Morningstar in London. And today I'm also joined by a panel of in-house experts who will share their views on their respective asset classes. And we are going to divide our time in a presentation followed by answering any listener questions. The audience can ask the questions by writing into their BrightTalk portal in the computer. So without a further ado, let's move to the main presentation. 2021 growth exceeded expectations in most economies, and 2022 forecasts are little changed according to our sovereign team. Monetary and fiscal measures put in place to save businesses and to stop mass unemployment worked, as shown on the chart. In the UK, the withdrawal of the furlough scheme at the end of September 21 did not result in an increase in the unemployment rate, which stood at 4.1% at the end of October 21 and was only 0.1% higher than the pre-COVID level in February 2020. But combination of money printing with higher energy prices and supply chain bottlenecks have become a fuel for rising inflation. The outlook for inflation remains mixed, whichever term is used by economists to define the current inflationary environment, whether that's persistent, rolling, or sticky transitory inflation. The fact is the inflation is rising, as shown in the second chart here on the side. And inflation is somewhat a hidden tax that affects from rich to the poor in society, and the consumers with the lower income households see the diminishing purchasing power and higher financing costs of debts as central banks tighten the monetary policy to curb the inflation. This may gradually flow through the securitization market in terms of collateral performance deterioration. And the rising interest rates, when considered in isolation, are not so bad for floating rate products in the fixed income world, which is most of the European securitization market, where coupons should move with the reference rate increases. But the rise of interest rates and increasing inflation also negatively affects the collateral performance, demand for further debt, and also collateral values. This slide will list some of the factors which we view as being supportive, as well as list of some challenges to some structured finance asset classes in 2022. And by no means this is an exhaustive list of all the factors, but overall we feel there are common factors like complete end of government support schemes, higher interest rates, inflation that could negatively impact overall the sectors in securitization markets. But on the opposing view, the macroeconomic growth is expected to remain stable, the unemployment continued to recover towards pre-pandemic levels. There is a strong consumer demand supported by strong asset prices. And easing of supply chain bottlenecks are some of the key factors that will support the performance outlook for 2022. And with that, I introduce our first speaker, who is the head of the European Structured Finance at DBRS Morningstar, Christian Ofstetz, who will take us through the issuance trends, ESG, and a few of the other factors in the securitization market. Christian, over to you.
Thanks a lot, Mudassar, and welcome everybody. So starting at European structured finance high level and on issuance, when we look back into last year, we think that, or we know that issuance in the securitization market surpassed most expectations, including ourselves. And that is especially true for the distributed or investor-placed issuance. So we saw last year that leveraged loan CLO issuance was at a record high ever. Auto ABS issuance, placed auto ABS issuance was strong. RMBS had a very strong comeback to issuance level placed with investors post Great Financial Crisis high. And consumer ABS was strong, and not to forget that CMBS staged a relatively strong comeback at low levels. And what is always not that much reflected in this data, which we show here, is the NPL market, which is in terms of gross book value securitized very, very big. In terms of placed bond balance, relatively small. But certainly that topic continued last year. So looking at what we expect for this year, all in all, we think that total issuance retained plus distributed issues will be down compared with 2021. In particular, we do not expect that some of the jumbo SME CLO deals which were retained last year will be repeated. But on the good news front, we think that investor-placed issuance will continue to keep up. So we expect there to be distributed issuance between 110, 115 billion, which is roughly the same as in 2021, but total issuance to be around 200 billion compared with 240 billion last year. So in a nutshell, we expect the percentage of distributed issuance to go further up, which in our view reflects the ongoing healing of the European securitization market since the 2008-2009 crisis. By sector, we think that RMBS issuance will remain stable, but that distributed issuance will go further up, also considering the number of transaction call dates coming up, in particular on the UK RMBS side. We expect slightly less on the ABS side, and where most of our total issuance decline forecast is coming from is structured credit, which includes leveraged loan CLOs as well as SME CLOs. So we expect leveraged loan CLOs issuance to hold up well, but the retained SME CLO issuance to go down. So that is the drop you can see at the lower right chart. We also expect the comeback of CMBS to continue, and the same for NPLs, where we think stable issuance year on year. The key topic is we expect more distributed issuance as a percentage of total. That usually comes with a lower average transaction size, which means that there might actually be more deals by number of transactions this year compared with last year. Turning to rating performance, I think 2021 in a nutshell is that across our rating book in European securitization, the rating behavior turned back more towards normalization. So the distribution of confirmation, upgrade, downgrade looks closer to 2019 than to 2020. And that's not surprising. So what happened last year was that upgrades from which were deferred in 2020 due to the uncertainty around the pandemic caught up in 2021, were actually higher than in pre-pandemic years, reflecting the bigger uncertainty in 2020 due to COVID. So what we're expecting for this year is more or less more of the same. So while, as Mudassar mentioned, there are certain headwinds on the horizon, namely removal of sovereign support post-pandemic, and also some inflation pressures on consumers. So there might be some worsening of collateral performance. However, there's usually the offsetting factors in securitization, which is the deleveraging. And such deleveraging should offset a marginally worse collateral performance in the vast majority of cases, so that our overall rating outlook is stable to slightly positive, i.e. more or less that of a normal year without major shocks. My last slide today is on a topic which is increasingly relevant across financial markets, and European securitization doesn't stand out, and that is ESG, or sustainable bond issuance. So overwhelming trend of last year was that European ESG-related or sustainable bond issuance has been increasing quite substantially, and at a very low level, European securitization did not stand out. So from a very low base, we saw that the volume of issuance in European securitizations, which had either a green or social bond label, went up substantially percentage-wise, and we've seen green labeled bonds in RMBS and CMBS, but we also see social bonds again in RMBS, in CMBS, and even consumer ABS. So for this year, we expect this trend to continue, as ESG is standing more and more at the forefront at the mind of investors. So we might see even green ABS this year, but generally believe that particularly the property-related asset classes, the trend towards more green issuance is going to continue. Obviously, as a credit rating agency, we always point out ESG is not credit, so we address credit risk. But according to our ESG criteria, we would outline if there were ESG factors which are relevant in our credit analysis, be it credit positive or be it credit negative. So that's the overall snapshot, European structured finance as a whole, and the key themes. With that, I hand over to Dan Tucker, who is our head of European RMBS and covered bonds.
Thank you, Christian. Welcome everyone to this webinar. I'm going to spend a few minutes talking about RMBS Outlook for 22. If we can talk of two sort of the main things, house prices and mortgage performance. House prices is one thing which, since the onset of the crisis, has surprised us positively. They have continued to rise in almost every country. The magnitude might be different, but in general, we have seen house prices increasing since the start of crisis across all the countries. And our view is that we would think house prices should remain stable this year. Generally, the factors which are pushing house prices higher are still remain in place. We think people do spend more time in house now, given they're working from home. So there is a desire for more space. Interest rates have continued to remain very low, and that allows people to get to borrow more and buy a bigger property. Also, as I think Mudassar touched earlier, our view is that the employment situation is improving, and in general, in most countries, the housing supply is not coping with the demand which is there. So in general, all the factors are there for house prices to remain strong. I think what might be slightly different this year is we expect to start seeing rate rises, which would affect borrowers. Well, even where countries where it's variable rate, they might be more affected because all borrowers would be affected. But even where the mortgage rates are fixed, the marginal borrower or the incremental borrower would be affected because they can borrow that much less when rates are rising. The other issue already kind of touched upon is inflation. Consumers are facing rising cost of living, including expectation that energy bills might rise quite sharply, and that might affect the amount of income people have left to cover the mortgage and other expenses. So all those might act as brakes on house prices, but overall we don't think there is any factor which will lead to a sharp fall in house prices. So view remains stable. Mortgage performance again has been quite robust through the crisis, and this is something which is in line with our expectation. We always expected mortgage performance to remain good. Now we, of course, had a lot of uncertainty last year in terms of what would happen based on the pandemic, how long it will last, and how borrowers will cope. We are now, while the pandemic is not over, we now have a reasonable amount of visibility on how borrowers are coping with it. The unemployment and GDP situation is improving. Of course, the risk remains that borrowers are used to support measures, not just the borrowers directly, but also in the economy. Businesses are supported by the government COVID measures, which might be withdrawn. In some countries, they are already on the way of withdrawing, but again, some measures remain, and that might again have some modest impact. But overall, we still think mortgage performance will remain robust in 22. Finally, touching on some of the themes we think we would see in 22, I think Christian showed a slide on ESG, and RMBS has always been sort of the leader on ESG-related issuances, and we expect in 22 that would continue. More issuers, not only existing issuers which have issued social or green bonds, but we'll expect more issuers to look at ESG-related issuances. So again, that would continue this year. It's interesting to see what will happen to interest rates. I think in the UK, there is broadly now a consensus that interest rates will rise, though modestly. This generally, because most mortgage lenders do take into account when underwriting the loans, we don't think that necessarily has a huge impact on mortgage performance, but it does, as I mentioned earlier, affect affordability. And so it is still a slight grade negative for rising interest rates. In the EU, I think currently there is less so of a consensus that rates will rise, but given the inflation is rising and things are returning to normal post-pandemic, we do think there is a risk that rates could also start to rise in the EU. Finally, on the issuance volumes, again, I think there's something Christian briefly touched on. Our expectation is that there would be more placed issuances, and the chart on the right kind of shows you why there is, if you compare it to 2020 and 21, the number of deals which are coming up for refinance, both in the UK and in the Euro area, are higher. So overall, we think there will be more activity, not only from new lending, but also more refi activity. So we expect more placed issuances. And with that, let me hand over to my colleague Paolo Conti, who is the head of ABS.
Thanks, Ketan. Thanks, everyone. I will try to cover a lot of content in a relatively short time. So you will have to bear with me that the content and some of the statement will have to be somehow general and schematic. First of all, looking generally a securitized portfolio, ABS securitized portfolio throughout the pandemic, we can say that credit performances remained largely stable. Currently, delinquencies and defaults are at or near pre-pandemic level. That's in itself somehow surprising given the unsecured nature of the product. Naturally, if you drill down into individual portfolios and specific jurisdiction and specific situation, we will see volatilities and differences. But overall, we can say that every specific situation, every case, every negative case can be reconducted to specific vulnerabilities. The reason for that is that originators adapted fast, as we have seen them, to the sudden shift in the risk profile of their customers and changed or adapted their underwriting and collection practices. Also, support scheme played a role directly or indirectly by mitigating the effect of the pandemic on the unemployment rate, so that the overall effect has been well contained. Specifically on revolving credit cards, due to their dynamic nature, the asset class showed a faster and more noticeable performance deterioration compared to other consumer products. And in particular, some portfolios with large percentage of non-prime customers. However, even when we have noticed the deterioration, the credit quality, the credit deterioration was relatively short-lived, and as we mentioned, originators quickly adjusted their practices, and again here the dynamic nature of the portfolios allowed the measure to be translated almost or very fast into an improvement. It's all positive, but nonetheless, our outlook for this sector remains carefully neutral because of the continuing uncertainties. In fact, performances of this segment remain sensitive, very sensitive to exogenous disruption. That's something we have learned in this crisis, is that credit cards are very sensitive. Looking at consumer loans, but in this case, excluding autos, although some statement may certainly apply to both. Consumer loans continued to demonstrate stable performance, and we have seen strong consumer performance through the pandemic, similar to the pre-pandemic levels now. I believe that the portfolios we have monitored show the noticeable resilience to short-term shocks drawn by the pandemic. From a speculative point of view, it would be interesting to see if this short-term shocks would become medium-term or long-term. But I think at the moment this remains in the realm of speculation. I think we are now looking at the future for consumer loans with some optimism, certainly, but we remain cautious as it is still difficult to assess the pandemic impact before the data is fully seasoned, and the support, public support or in specific originator support is waived and fully withdrawn. Something more in specific on autos, given that it's such an important part of European ABS. I think the first thing we noticed is that new vehicle registrations went down, not only last year, but at least for the past 2 years in the 5 most important jurisdictions for auto loans in Europe. This is due, of course, to a variety of causes: interruption of production, shortage of key elements of the production system, like silicon element. But I mean, I prefer not to dive too much into this. But surely this has had consequences, and because of the demand offer dynamic, this sustained used vehicle prices that went up. And this contributed to support strong performance, credit performance in the sector. As a general statement, we can say that this cannot probably continue as it is, and because prices that went up at some point will have to go down when the supply chain normalizes. But we expect that the price of used vehicles should remain at least stable during 2022. The sector overall continues to adapt to new vehicle supply constraints, and we see we see continuing the transition to alternative fuel vehicle, hybrid, electric, and increasing use in financing products up to managed trade cycle. We also see the continued tendency to shift from vehicle ownership towards vehicle usage with a change in consumer habit. But that's almost an older story. In short, to close, Christian already covered the issuances. If we can add something, probably we can expect ABS, auto ABS issuances to be stable. Probably we will see more diversified issuances, possibly smaller and in larger numbers. Difficult to say. And I mean, I think I've said already a lot. And I'll pass to Mirko, who's heading the CMBS team.
Thanks, Paolo, and good afternoon to everyone. So we will basically split this short presentation on the European CMBS sector in two parts. The first part will focus on the performance of the CMBS in 2021, which, as been mentioned already, was overall a stable performance, as highlighted by the fact that we didn't really have any transfer into special servicing of any transaction in 2021. And in general, actually, we have started to see towards the end of last year, actually signs of recovery also for the asset class that has been most severely hit by the pandemic. And I'm clearly referring to the retail sector and the hospitality sector. But talking about the reason for behind this stable performance of the CMBS sector, I think it was already highlighted the fact that we have seen during the pandemic a strong support from the sponsor that has been backing the transaction even with the equity injection where necessary. And also one of the main reasons why European CMBS has performed well is that actually the large majority of the assets securing European CMBS are actually logistic assets, which, as we know, has probably been the asset class that has been performing better during the pandemic, and the asset class that actually we think is going to keep performing well even in the future as this shift towards e-commerce keeps increasing. It keeps improving the outlook for this sector. So as we just, for example, we look at the portfolio that rated by DBRS Morningstar, we actually have pretty much almost 40-45% of the transaction which are backed by logistic asset and explain this good performance. But as I said, even other asset class, we haven't seen a really dramatic downturn in 2021. As I said, for example, in the hospitality sector, we started to see an improvement in the performance and numbers starting to improve, as well as the retail sector, which in particular, the shopping center area where, with the reopening and the easing of the lockdown and the other measure to contain the pandemic, the rent has been starting to increase, and the reopening have definitely helped the trade and the sales in the shops, and as a result, also on the rental income side, we have seen signs of this improvement. And then we also we have seen strong interest towards, for example, the residential sector, which is a relatively new asset class in European CMBS. You probably, most of the people that have been looking at CMBS the previous year remember some German multifamily transaction in 2013-14, but we haven't seen a residential transaction what we call multifamily for a while. And in 2021, actually, we saw a few issuance, and we expect to see more in 2022, as again also the residential sector came out as of, let's say, one of the winners of the crisis. Finally, I will briefly mention just on the office sector, we haven't seen a huge sign of distress on this asset class. Transactions secured by office property haven't been really underperforming, but on this asset there is still quite uncertainty, and in particular on see how the pandemic will really impact this this sector, as more people are working remotely, and as a result there could be the tendency for company to reduce the space for office in the organization. We can now switch instead to let's say the second part of this presentation, where we're going to have a brief look at what we expect in 2022. As previously said, 2021 so actually quite strong rebound of European CMBS, with over 15 transactions publicly issued, and around 6 billion of new issuance. We would expect 2022 to have a similar path, maybe some more transaction and a few more millions issued. And in particular, we will still think that logistics will probably remain the dominant asset class in terms of new issuance. But for example, we will also expect to see more transaction backed by office. This is because we think that arrangers are going to start to have and banks in general are going to start to have a more cautious approach towards this property type. As I mentioned before, there is still quite uncertainty on how really the impact of the pandemic will be on this sector. And as a result, we would expect more office portfolio to find their way to the CMBS market. As previously said, I would expect more residential transaction as well to to end into the CMBS market this year, as well as I would expect to continue the trend of operational assets, like we have seen already, gas station or cold storage or social housing being securitized in CMBS. With there's been a strong demand for this operational assets in 2021, and we think the interest is out there, and will be actually probably even stronger in 2022. Finally, we would expect maybe 2 or 3 transactions to actually include a more granular pool than what we have seen so far. European CMBS in general has been a market for single loan transaction, or really few number of loans in the pool. But I think 2022 could actually see more larger pool with maybe even 8, 9 loans included. And with this, I finish this section about the European CMBS, and I will hand over to my colleague Carlos, who had the structured credit team.
Hi, Mirko. Thank you. Welcome, everyone. So let me start by briefly summarizing 2021. Against our expectations, we observed a very strong year, both in terms of issuance and performance. I think this was mainly caused by a combination of factors, significantly global support measures, low interest rates environment, and quantitative easing. As such, we had a year of record issuance for European CLOs. Also in the US, CLOs, a very strong year. And as you can see on the top chart, a low level of delinquencies across leveraged loan collateral, where we saw a spike in 2020 immediately after the pandemic, and with the, if you remember, the oil price and the energy stocks, the energy companies really doing poorly last year with the oil price sinking. That's now recovered. In wider corporate and SME universe, statistics also show a drop in bankruptcy levels across the EU to historically low levels. So the graph at the bottom from Eurostat, we really see that surprisingly, despite the disruption in GDP, we saw a massive drop in bankruptcies, and that was mainly caused by the type of measures brought together across different European countries. these trends have now started to stabilize, and we see some countries already starting to increase bankruptcies towards, let's say, levels that are similar to pre-pandemic. So in terms of SMEs, we continue to see in 2021 a lackluster issuance, even though we saw a couple of jumbo transactions, but we saw low levels of defaults. Mainly caused also by government guaranteed loans with favorable terms that also led to an increase in prepayment rates, which combined provided support to a universe of rated SME CLOs with a large number of rating upgrades. We actually only downgraded 2 transactions, and that was following amendments to those transactions where they've changed the capital structure. So moving on to the second slide and the outlook for 2022, I think we can summarize that the worst has been avoided following the pandemic, but now we're probably have to live with the collateral effects from the remedial actions that will loom in 2022. There will be persisting high inflation, supply chain issues still affecting margins and profitability. Interest rate rises will lead to increased funding costs as well. And we still have to live with an asymmetric recovery of the economy. So certain sectors doing very well, and some other sectors still struggling. And in 2022, we expect to see the end of many of the support measures, government guaranteed loan schemes, debt payment moratorium, ending of restrictions on winding up petitions or insolvency procedures. All of these are likely to end this year. And what does this mean? Well, we expect to see a gradual increase in delinquencies and defaults in SMEs throughout 2022. Tourism and hospitality sectors to us still remain very vulnerable to the pandemic. Again, we say this compared to the exceptionally low default year we have in 2021. We expect that despite the rise on defaults and delinquencies, we don't expect them to be problematic for the performance of the transactions that are on the market, the SMEs that we rate. In terms of new issuance for SMEs, we think that the factors remain the same, so they continue to be subdued issuance, although it's difficult to predict if we're going to have any big jumbo transaction or not, but they tend to be larger than other asset classes on average. So expect around 6 to 9 transactions, totaling around 10 to 20 billion. For CLOs, again, we expect some deterioration on performance, but perhaps faring better than SMEs given their size, their sponsor support, and the fact that they are typically more resilient businesses than many of the SMEs. A strong issuance is still expected for CLOs, although it may be affected by market economics of arbitrage, and so should perhaps be below 2021 record levels. So this concludes my short presentation, and I'd like to hand over to Sinem, who will cover the NPL portfolio.
Thank you, Carlo. Welcome, everyone. Past couple of years were interesting years for the non-performing loans product. The outset of the global pandemic from March 2020 had a significant impact on the global economy, causing a substantial contraction in economic activity. But throughout this time, the policy responses deployed at national and European level were generally effective in preventing significant increases in non-performing loan amounts on banks' balance sheets. Separately, jurisdictions which entered the global pandemic with high NPL ratios continued to work hard to reduce these during this time. So past 2 years saw significant reduction in NPLs in Italian, Greek, Portuguese, and Cypriot banks' balance sheets through securitization, direct sales, and sales to national asset management companies in the case of Italy. Most notably, the Greek NPL ratio in the top 4 largest banks' balance sheets reduced from an average of 35.2% as at 2019 year-end to 10.5% by the end of Q3 2021. So these countries are now better placed to face what lies ahead. Stable real estate prices through 2020-2021 helped the performance of secured transactions. On the NPL bond performance side, throughout 2020-2021, we saw increased negative performance of European NPL transactions, particularly in Italy and Spain. This was partially due to court closures and disruption in servicing activity, and partially due to optimistic initial business plans, which were later revised by servicers as the slowdown of the legal system led them to formulate more conservative views on recovery expectations for the near future, in many cases for the medium and long term. And also due to transaction-specific features such as liquidity support structure, pool composition, servicing strategy, etc. As a result, some transactions have proved to be more vulnerable to the crisis than others, especially in cases where restrictive measures imposed by the local authorities were tighter with longer duration, such as Italy, and where a transaction's cash flows are more dependent on the implementation of judicial recovery strategies. We observed that underperformance of DBRS-rated Italian transactions were concentrated in those issued pre-June 2019. Issuances rated after June 2019 with tighter structural features performed better, save for a few exceptions. The only Spanish NPL transaction for which we have received meaningful performance data is currently performing significantly below the servicer's initial recovery expectations. This is a trend that was observed since issuance, but has been more pronounced since the outbreak of the pandemic. Portuguese transactions, on the other hand, generally displayed healthier performances throughout the pandemic, albeit a slight decline in gross recovery levels for the more recent transactions. 3 Portuguese transactions rated by DBRS Morningstar saw upgrades in ratings. For Ireland, the business plans of DBRS Morningstar rated transactions are below the initial business plans, where the business plans depended on sale of recovered receivables once reperforming. Having said that, there were no downgrades in Irish NPL transactions, and some upgrades were observed in the junior tranches. In terms of new issuance, after dipping volumes in 2020, issuance was back to circa 2019 levels in 2021. Moving on to the next slide. After a strong rebound in 2021 with GDP growth of 5.2%, OECD projections anticipate economic activity in the euro area to expand by 4.3% in 2022 and 2.5% in 2023. Growth will likely be supported by consumption as households reduce their savings rates and higher investments owing in part to national and European recovery plans. As also mentioned earlier on in the presentation, unemployment is projected to decline. However, the growth mentioned wasn't evenly distributed across Europe. The chart on this page shows the OECD analysis of the GDP gap to pre-crisis levels. This graph shows expected Q4 2021 versus Q4 2019. According to this study, Spain still has more catching up to do with a GDP gap of 6.3%, while Netherlands is ahead by 0.5%. Some other trends that have appeared in 2021, in particular higher inflation and the emergence of new variants of coronavirus, might be more prolonged than previously anticipated, delaying a return to a new normal. Looking forward, inflationary pressures on affordability and possible corrective measures to interest rates could put pressure on household incomes and profitability of businesses. This, together with reversal of the national and European extraordinary measures put in place and the pre-crisis GDP gap, in turn could have an effect on the size of non-performing loans on that balance sheet going forward, and could also result in possible weakened performance in existing NPL securitization. Expectation for 2022 issuance remains dominated by peripheral economies and in particular Southern European jurisdictions. However, considering the systemic scale of the problem at the European level, it's possible to see rated transactions in new jurisdictions, And considering the limited cost for governments as compared with other solutions, the introduction of similar schemes such as GACs and HAPs in jurisdictions other than Italy and Greece might be possible. In summary, we anticipate the renewed dominance of Italian NPL issuance to taper from its 2021 level and more regional diversity in public issuance to ensue, resulting in similar public issuance level to 2021 for 2022. With this, I hand over to Mudassar for closing remarks.
Thank you, Sinem. Before I summarize our views, this would be a good opportunity for audience to ask any questions, which need to be asked in writing by typing into your computer. So to summarize, 2020 was the year of shock. The European securitization market went through a rapid change as the pandemic evolved. And 2021 was the year of recovery. The market tried to look past the pandemic and went full steam ahead with robust collateral performance and fed investor appetite with strong issuance volumes. Now, looking ahead to 2022, the European securitization market is firmly back on the road, albeit a curvy road. And in our published Outlook report, one cannot say with conviction that we will not have an odd curveball thrown that can escalate into a widespread market uncertainty. But one does take comfort that low default rates, stable collateral values, and renewed confidence in certain securitization sectors can withstand this uncertainty. Now, we also expect Europe to lead the shift towards sustainable capital markets with more ESG-related transactions coming to the market. In 2022, as Christian also mentioned, we forecast total European securitization issuance to be around 200 to 210 billion, slightly lower than the 2021 issuance volume of 240 billion. So out of this expected 210 billion issuance, we expect 55 to 60% to be marketplace transactions, slightly more than the previous rolling average of around 60%. So with that, we conclude our presentation. And we have no questions so far, but we remain available. The presentation materials along with our latest research and contact details of analysts can be found on our website, dbrsmorningstar.com. I take the opportunity to thank our audience, and I hope you found this session useful. And thank you, fellow speakers, for taking the time to participate in this webinar.